Would you be inclined to chase the money at this point and put it to work?
No, I wouldn't. What we're seeing in the markets is risk on, because clearly the Fed is most reluctant to increase interest rates, and whereas the market thinks there might be one rate rise this year, there probably will be two. So I think the repricing of equities and every other form of risk asset really reflects simply the perception that central banks, in particular the Fed, are simply not going to raise interest rates and will use any excuse not to raise interest rates. Therefore, you're still looking at more money chasing the same amount of assets. You're looking at the risks, as we were talking about earlier, of negative interest rates, which of course impact the whole yield curve, and they impact what assets people then try to get some yield out of. So if you're going to be charged to hold cash, then you're probably going to buy something which you get paid something on, but the something gets smaller and smaller, and therefore the price of that something has been going up. In other words, the yield goes down and down.
So what is the appropriate action to take around this risk-on phase?
Well, I think my own view is that I think equity markets are extremely risky here, because if you actually back away from our getting up in the morning and looking at this stuff daily, we're too close to the screen. In reality, what's happening is that the earnings streams are actually falling, and given the growth prospects, there isn't much hope that they're going to rise very quickly. So the only thing that's working for you is the fact that money is cheap. It could even get cheaper in certain places in the world, and therefore what do you do? But that is not sustainable, because at some point interest rates will rise, and then the falling earnings streams mean that the present value of those earnings streams are less, which means that frankly you're going to see PE contraction around a falling earnings stream. So I think equities are very dangerous, so I would stay well away from that.
David, investors in Asia got a little bit feverish today about moves by Singapore to stop the appreciation in the currency, and across the region you saw gains, and this was cited that investors thought this would be positive for other central bank stimulus, that they saw this as a sign central banks are willing to do more. It's hard to see the correlation between Singapore and any other central bank across Asia.
Well, very, very difficult. I mean, Singapore has got one policy instrument which they use, which is the exchange rate. And they use it normally to appreciate gradually every year, which is intended to push the Singaporean economy up the value-added chain and make sure they make things which China doesn't make yet or whatever. Now, what they're saying at the moment is that growth in Singapore is weak. I mean, we're looking at 2%. Very, very weak by historical standards. And for domestic economic reasons, it's justified to no longer use an exchange rate policy which implies gradual tightening of monetary policy and monetary conditions. So that's all they've done. It doesn't really tell you anything about them going to a more extreme policy, say, of depreciating the exchange rate. I don't think so. And it has practically zero implications for other central banks in Asia.